Yesterday, everyone trusted this bank. This morning, everyone wanted out. In just 48 hours. This is how Silicon Valley Bank collapsed.
It was the Bank of Silicon Valley. Nearly half of all venture-backed startups in America banked there. Then in 48 hours, it was gone. $42 billion withdrawn in 2 days. The second largest bank failure in American history. This is Silicon Valley Bank. It was the Bank of Silicon Valley, not metaphorically, not approximately literally. Nearly half of all venture-backed technology and life sciences companies in America banked there. When a startup raised its first round of funding, the investor often required them to open an account at Silicon Valley Bank. It was the default, the standard, the institution that the entire startup ecosystem trusted. Then, in 48 hours, it was gone. The second largest bank failure in American history. And the extraordinary thing is that it was not brought down by fraud. It was not brought down by reckless lending to bad borrowers. It was brought down by something almost embarrassingly basic, a failure to understand. What happens to long-term bonds when interest rates rise quickly? This is Silicon Valley Bank. And this is the story of how the most trusted financial institution in the world's most innovative industry collapsed because of a baton interest rates that turned out to be wrong. Silicon Valley Bank was founded in 1983 in Santa Clara, California. According to legend, it was conceived during a poker game between a group of entrepreneurs and bankers who believed the traditional banking industry was not equipped to serve the needs of technology. Startups for 40 years, SVB served that niche brilliantly. It understood startup companies in ways traditional banks did not. It understood venture capital. It understood burn rates and runway. It understood that a pre-revenue startup with a brilliant idea was worth lending to. Technology industry loved SVB, and SVB grew alongside the technology industry. By 2022, Silicon Valley Bank had $209 billion in total assets. It was the 16th largest bank in America. Then, the problems began. During the COVID pandemic years of 2020 and 2021, the technology industry boomed, interest rates were at historic lows, venture capital was flowing freely, startups were raising enormous rounds and depositing enormous amounts into their bank accounts. Silicon Valley Bank saw its deposits surge from $60 billion in 2019 to $189 billion by the end of 2021. That is an extraordinary amount of new money to deploy in a short period of time. SVB invested much of it in long-term government bonds and mortgage-backed securities. This seemed, at the time, like a reasonable decision. Government bonds are safe. Mortgage-backed securities are relatively stable. The problem was the duration. SVB bought long-term bonds that would not mature for 10, 15, even 20 years. And then, in 2022, the Federal Reserve began raising interest rates aggressively, repeatedly, rapidly. When interest rates rise, the value of existing long-term bonds falls. This is basic financial mathematics. A bond paying 2% interest is worth less. When new bonds are paying 4%, SVB's bond portfolio, which had been worth close to its purchase price, began losing value rapidly. By the end of 2022. SVB had unrealized losses of approximately $15 billion in its bond portfolio, unrealized, meaning the losses were real, but SVB had not sold the bonds yet, so they did not appear on the official books. As long as SVB could hold the bonds to maturity, the losses would eventually reverse, but that assumption required one thing: that customers would not simultaneously demand their deposits back. In early March 2023. That assumption failed. The technology startup ecosystem, which had been thriving during the low-rate years, was now struggling. Interest rates were high, venture capital was slowing, startups were burning through their cash reserves faster than they could raise new money, and so they began withdrawing from their SVB accounts to fund their operations. SVB found itself needing to sell bonds to meet withdrawals, but the bonds had lost value. On March 8, 2023, SVB announced it had sold $21 billion in bonds at a loss of approximately $1.8 billion to cover that loss. It announced a plan to raise $2.25 billion in new capital. The announcement, intended to reassure, had precisely the opposite effect. Within hours, prominent Silicon Valley venture capital firms began telling their portfolio companies to withdraw their deposits from SVB not next week, not tomorrow. That afternoon, Peter Thiel's Founders Fund, among the most influential in Silicon Valley, sent a message advising companies to move their money. The digital bank run had begun in the 48 hours following the announcement. Customers attempted to withdraw $42 billion. $42 billion in 48 hours. SVB could not process the withdrawals. On March 10, 2023, California, regulators seized Silicon Valley Bank. The Federal Deposit Insurance Corporation was appointed as receiver. It was the second largest bank failure in American history. Only Washington Mutual in 2008 had been larger. The collapse sent immediate shockwaves through the technology industry. Thousands of startups, many of them with their entire operating cash inside SVB, faced the prospect of being unable to make payroll the following week. The U.S. government moved with extraordinary speed. Over the weekend of March 11th and 12th, the Federal Reserve, Treasury Department, and FDIC announced jointly that all depositors at SVB would be made whole, not just the FDIC-insured amount of $250,000, but all deposits, regardless of size. The decision was controversial. Critics argued it was a backdoor bailout of wealthy venture capitalists and their portfolio companies. Supporters argued it was necessary to prevent a broader bank run from spreading to other regional banks. Both arguments had merit. The fallout continued. Signature Bank, another crypto and tech-friendly regional bank, was closed by regulators. The same weekend, First Republic Bank, another regional lender with similar interest rate exposure, collapsed. In May 2023, the broader regional banking crisis of early 2023, which also claimed Silvergate Bank, was substantially triggered by the SVB collapse. Greg Becker, SVB's CEO, was called before the United States Senate to explain what had happened, i.e., testified in May 2023. He acknowledged that SVB had not adequately managed its interest rate risk. He said the bank had made mistakes. He accepted responsibility. He was not criminally charged. In October 2023, the Federal Reserve published a scathing internal review of its own supervision of SVB. The review concluded that the Fed's supervisors had identified multiple risks at SVB but had not acted quickly enough to force corrections. The failure was not just SVB's failure, it was also a regulatory failure. So what is the real lesson of Silicon Valley Bank's VB is not a story about greed in the traditional sense. Nobody at SVB was secretly enriching themselves at the expense of customers. Nobody was running a Ponzi scheme. Nobody was sending customer money to a secret trading firm in the Bahamas. SVB made a straightforward, and in retrospect, catastrophically wrong, bet that interest rates would not rise fast enough to destroy the value of the bonds it had bought with customer deposits, and when that bet proved wrong, the concentrated nature of its customer base, all connected through the same venture capital network, all receiving the same advice from the same investors at the same moment, meant that the bank run happened faster than any traditional bank run in history. The lesson of SVB is about concentration of assets in long-term bonds, concentration of customers in a single industry, concentration of information in a connected network where bad news travels at the speed of a tweet. In the age of digital banking, a bank run that would have taken weeks in 1929 took 48 hours in 2023. The speed was new, the underlying story of a financial institution that mismanaged the mismatch between the duration of its assets and the demands of its depositors is as old as banking itself, that is the capital case, subscribe to the capital case because the next case is already waiting.